Good afternoon, everybody. Thank you very much for joining me today. So we have our Q1 update on the state of venture capital, and wishing everyone an Eid Mubarak for those that were celebrating. And in this special occasion, I thought it's useful, and we used to do this a while back, and I've done a few recently. We have a special guest that will be joining us after the presentation. So the way that we're going to do today's session is just a short 10-minute presentation of some of the latest data, and then to get into the context of a deep dive for about half an hour, and then open up the floor to questions. So if you have any questions, please share them in the Q&A box. Please put them in the chat box, and we'll get to them at the end. And I'm super honored to have Sharif El-Badawi joining us for that session. But as ever, just wanted to give you a little bit of an overview on the latest numbers that can provide, as I said, some context for the meeting that we're about to have. Any of the data you can download from the platform. So if you have a phone and want to access any of the information, feel free to do so, and I'll share another image at the end of the call. So as has become tradition in any of our presentations, I like to start with a little bit of a macroeconomic overview. While it's only been 3 months of this year, again, some interesting different trends. If you look at the US markets, they continue to surge. At least in Q1, the Nasdaq up 9% at the end of the quarter, the S&P at 10%. So in both cases, reaching almost record highs. Interesting though, and I have said this on many occasions, including webinars as well as in posts, that the interest rates are devil. High interest rates is the devil to venture capital, and the Fed has decided to continue to maintain them at 5.5%. Jerome Powell indicating it's unlikely that there'll be any rate cuts now until potentially September. And in fact, the street, including Larry Summers, who was the previous head of Harvard, stating that there may even be rate hikes in the future. So this will likely be a bit of a challenge for venture capital as an asset class. Carter, that continues to put out great data for the database of companies that they have, highlighted some interesting points around startup shutdowns, a metric that is very hard to capture and one that we continue to try and see for the MENA region. But the reality is that they saw the highest level of startup shutdowns for years. And in fact, I'll show you a chart looking at Q1, that trend continues going into 2024. And oil prices, given all the geopolitics and the challenges that we have in the wider economies, actually ended up, despite being lower in 2022, has seen an increase of about 13%, with the double-edged sword of what oil prices provides sovereign entities the ability to deploy capital, increased inflation as a result of higher production costs. And here are just one or two charts to kind of indicate that. This chart that I asked the team to continue to update is the Fed's fund rate, the last 3 recessions, and the impact in this particular case of the S&P 500 at record level highs. So the question being, how is the private market reacting to interest rates? And then global venture capital, which has seen a decline dating back to the levels that we've seen in 2019. Again, the points that were made around quarterly shutdown of companies, the trend continuing going into 2024, the highest level for at least 4 to 5 years. But how does that impact venture? And that's what everyone's here for. Taking CB Insight's chart, it's interesting to see that global venture capital, and starting with deal flow, has seen 8 progressive quarters, straight line almost, of a decline in the total number of transactions. In terms of funding, we've now basically plateaued to the levels that were seen in 2019 and 2020, with basically 1 quarter higher, 1 quarter lower on a regular basis. We've always said that the US acts as, or the global trends act as a potential indicator of what's happening in our regions. So when we look at the emerging venture markets, interesting to note that finally we're beginning to see a similar trend to what is happening globally. 6 progressive quarters of decline in terms of deal flow activity, and this plateauing, again, emerging venture markets, the markets that MAGNiTT particularly covers, Africa, the Middle East, and Southeast Asia, mimicking the trends that we're seeing, albeit 2 quarters delayed to what we see at a global level. One of the things that is interesting to note is the impact of mega deals. Now, CB Insights and global platforms don't necessarily show that because the skew of those $100 million plus deals is less relevant in more mature markets, but in the emerging venture markets, they play a contributing factor. And what we saw in Q1 is that the level is similar to what we saw last year in the summer. one mega deal investment in Saudi Arabia, one with Move in Nigeria, and one in Singapore as well. So the levels are very muted compared to previous years, and one of the questions I'll come on to ask in a bit. How did the MENA region fare? Well, deep diving into this part of the world, we actually saw, after what was a record Q4, which I highlighted and caveated many times, was a buildup of investment activity from the summer. As you can see, Q2 and Q3 being almost flat after the start of the year. We saw a pickup of that activity in Q4. But having said that, we've seen a year-on-year decline, both in terms of capital deployment and in the total number of transactions, with only one mega deal contribution from Saudi Arabia. Just to give some perspective, all are similar trends in each of the markets that we're covering. Africa, almost the lowest level of investment capital and deal flow activity dating back 4 years. And in Southeast Asia, a similar trend to the CB Insights Global one, just a straight line decline starting from Q2 2022. And when you put this across the whole of the landscape, it is interesting to know that deal flow is a little bit flat, if not up, in Europe. The percentage decreases are on average around 30%, and we're now falling very much in line with the global averages, which is a trend that we're expecting to continue until we see a cut in interest rates across the global landscape. So one of the things that we'll be coming on to discuss is how long will this continue for? Just to look at some of the different type of geographies, similar to the report that we did at the end of the year, Singapore outstrips the region here, naturally, given that it's somewhat more mature than the ecosystem here in MENA, but it still saw a drop of about 8% compared to Q1 of last year. Saudi Arabia still maintaining its position as the leading geography across MENA, but now ranked first in terms of capital deployment, a second for the MENA region, second across the whole of the EVMs that we cover, up one place year on year. And in terms of total number of transactions, Singapore still is one of the most fertile, followed by Turkey, Saudi Arabia, and the UAE. If we deep dive into some of the kind of trends of investment behavior, it is interesting to note that the bracket, and this is the MENA region's share of investment activity by transactions, 50% was attributed to deals between $1 million to $5 million. Effectively, early stage remains somewhat robust, with more investment tickets taking place at the very early feed series A stage. And it'll be interesting to hear Sharif's perspective on whether there is a change of sentiment from investors as to where to deploy capital. In terms of sectors, fintech, which really was the standout industry and sector. Many people keep asking me, where is a lot of the investment capital going in terms of the investor appetite? In terms of transactions, remains first, albeit down 30% year on year. E-commerce, somewhat skewed by the investment in Saudi Arabia, the mega deal ranks first. Strip that out, fintech still is greater in terms of capital deployment than the next three industries combined. In terms of investor activity, we are only at the beginning of the year, and we see that there has been, interestingly, a slight uptick in the number of institutions making investments, up to 141 compared to 134. And the percentage of international to regional remains roughly the same at around 40%, which continues. And in terms of M&A activity, while I had again started the year saying that this would be a record year of investment M&A activity, in fact, there's been a very muted start to the year, which is likely to potentially continue going into Q2, but we'll have to see how that pans out to year end. So if you are interested in downloading any of the reports and accessing any of the data, feel free to use your phone, and I think the team are sharing some of the links. And I now welcome Sharif El-Badawi, friend, as well as CEO of the Dubai Future District Fund, to join us. I'll give him a second to unmute and join us on video so that we can deep dive into some of these data points that we've just shared across the board.
Thanks, Philip. I think you'll have to turn on my video. It won't let me turn it on.
Says ask to start.
There we go.
Perfect. Great.
Awesome.
Thank you for joining us. Pleasure to see you.
Thanks for having me. Great to be with you.
Thank you. Well, Sharif, as I kind of advertised, I wanted to have a very frank and honest conversation about what's happening in this space. I mean, before I can jump into anything specifically, any takeaways from the data? I don't know if you've seen it in advance of the call. Anything that you found particularly striking or shocking or interesting?
Well, I mean, I think the little bit of a letdown because I think we both ended Q4 last year with some hope that we're not following the same trajectory as global. And what you just outlined and showed in the numbers is that we're now normalizing to the global trend in a stronger way than it looked like we were last year. It looked like certainly there was a couple quarters lag at the beginning of the downturn, and then the behavior in MENA seemed to not follow the same path as everywhere else. But now it does seem to be normalizing towards that. However, on the ground, it does seem that investor sentiment, at least from the funds that are part of our portfolio and that we speak to often, they've seen a massive uptick in deal flow coming in at the top of the funnel since January. We here at DFDF, because we also do direct investments, did not see quite the uptick that they see, but we're also geographically a little bit more restricted than the funds that we cover. So I think in pockets of the MENA region, there's certainly more deal flow coming in at the top of the funnel. I think what has not panned out in your reporting yet is that those deals have closed if they make it all the way through to an investment. I'm optimistic still for this year, except for the news from the Feds. That was another sort of disappointment that happened this quarter. I expected two declines this year in the second half. I think everybody's saying higher for longer, and you're saying the same. That will hinder. Certainly, I think that will hinder and make us normalize to the global trend even more for a couple more quarters. So what I had hoped for and was optimistic about is that Q2, Q3, Q4 this year, for MENA at least, are going to be strong recovery quarters. That seems to be remain to be seen or maybe delayed further.
I want to just double click on this interest rate point because I keep mentioning it and I'm happy to explain it myself, but I would love to get your perspective. For those that may not naturally or understand the correlation, why is it that this interest rate environment is likely to see venture as an asset class be less attractive potentially for investors? And why is it that we're waiting for that to come down before we see more capital being deployed?
Look, I come from a different kind of background. I'm not an economist or a finance person by nature. So I also don't quite understand why the correlation seems to be so close. However, at least in my position here and what I'm learning along these years is that investor sentiment is closely tied to it. So investor sentiment sprawls across asset classes regardless, and it just kind of spreads out. So whether it actually is a primary effect onto venture, I don't think it is. I think it's some kind of proxy, mostly related to investor sentiment. But then there's also this denominator factor where asset managers or wealth managers, their money might be tied up into other asset classes that are affected by interest rate, like lending and other credit things. But that may prevent those type of fund managers or asset managers from allocating more money to venture because they're busy, putting out fires on the other side. So I think those are the two correlations to why it's affecting venture spend. Certainly at the top of the food chain, when it comes to fund of funds and LPs, they probably are managing a diversified portfolio and have to have those considerations in place. So I think that's part of it. It also seems to be another one that I think that would be maybe an analogy to this is the oil prices and where we are and the momentum and the government's motivation these days and the GDPs of these countries all pointing up and to the right. So oil prices going up, you would think would be a strong indicator of additional or increased spend here in the region. But it doesn't seem to correlate so directly. So I think these things, because we're tied into the macro and there's really no avoiding that, and we're tied into the global markets in themselves. Dubai, especially, I think is very much correlated to the global markets. It's going to have some kind of trickle down effect into the venture category, although it really isn't related to the way that we make investments in startups and the years that go by before those startups have to face either one of those dynamics, unless they're maybe in lending and fintech or something like that, where it is directly correlated for their debt balance sheet.
I mean, just to add to that from my side, I think it's also just the crowding out effect. So if you're an LP and you have X amount of money, clearly if interest rates are at 5.5, percent, you can slap it into a bank account. The stock market, as I mentioned at the beginning, is at record highs and continues to be strong, which defies any logic, and therefore the returns that you can get from there are particularly high. And therefore your expectation, I assume, both as an LP and as GPs that are investing in startups, is that you need to have returns of about 25, 30%. And how many companies are able to do that in this risk environment, as opposed to when interest rates were at 0% and you had no alternative but to invest in asset classes that were potentially giving you returns. And I think that's part of it. It's both the LP side and on the GPs, you have to just wait until that IRR calculation becomes more attractive from a certain perspective.
Yeah, true. I think everybody understands that interest rate makes capital less available, and we were in a hype cycle for a long, long time. So money is tight and dry everywhere. But when you think about LPs, if they're pure venture LPs, their capital base is not necessarily tied to that. But let's say it's available, and in our region it is available at the fund of funds and LP level. And they have dry powder still. Many of the institutions here are getting re-upped again with billion plus allocations. And then that money is going to GPs or fund managers, venture fund managers. And then they're not affected by interest rate either. So yes, I understand the logic at the macro level, but if you just look at the three tiers of LPs, GPs, and then the startups themselves, and the startups that we invest in may not be affected by this because of the sector or whatever that they're in, should follow the consumer spending trends and the market trends more than should follow interest rates. Now, as long as it's not tied to credit. But we are observing LPs with dry powder, including ourselves. We've held back on spending, not for any great reason, except deal flow has been low and sentiment has been weak. But the startups that they're doing all of the things that we've asked them to do 2 years ago, which is look at bottom line, economics, stronger governance. We have strong GDP growth in Saudi and the UAE and the other markets. So really, it should be somewhat unaffected, but I know that's just not the case in how the world works.
It's a lot to unpack there, and I have lots of questions. So one thing I wanted to get your honest opinion on, which I find interesting and challenging from my perspective. If you read MAGNiTT, if you read the news, if you read any publications, that last year saw a plethora of fund announcements across the board in Saudi Arabia, UAE, and there's a lot of talk that there is dry powder available, and yet it hasn't quite translated into deployment. From the mechanics of that, is that actual dry powder? Is it just it hasn't been capital called? Is it takes time to go into the system? I mean, obviously there's different reasons as to why, but I mean, the numbers are the numbers, and they're reflecting that there's a slight slowdown, and we don't anticipate that that's likely to continue to pick up until potentially Q4. But if you actually aggregated all the fund announcements of last year, you're talking about probably close to over $1 billion of fund announcements that have been done. What's that potential disconnect?
From where I sit, it's real. I mean, the LPs have the money. We have committed, us and many others have committed to those funds that are making announcements. They seem to be raising record-sized funds compared to pre-COVID levels. And they have the money, and they can call it from us if they want. And on our direct side, we have the money too. We're actually behind pace for the last 18 months. But there seems to be a funnel problem as well. Again, I mean, I have a geographic restriction, maybe that others don't, but from what I can see, the top of the funnel is smaller and weaker than it used to be. So I don't know if I used to say that could be a factor of founders, smart founders kind of know what the market is, and they're holding back from approaching investors until things level out and they don't have to take a down round and so on. That may be one factor. I think there's multiple factors affecting each other. But I really can't explain why so many of us have dry powder, yet you're not seeing the numbers in the charts.
One thing, and so we've known each other for a while, and we've been talking about the MENA region for a while. One stat that the team pulled up, and of course it's only Q1, but I don't think it's too disparate to what happened last year. 65% of total funding last year came from Saudi Arabia. even if you remove, oh, sorry, in Q1, even if you remove the 130 million mega round in Salah, the kingdom still accounted for nearly the next three countries combined. Now, obviously, that's Q1, and UAE ranked second across the wider MENA region last year. Beyond UAE and Saudi, what's happening in the MENA region in terms of investment? And is that something that is a bit of a challenge for the wider MENA region and ecosystem right now?
I think there's an ebb and flow into these cycles, and we have been in a state of siloed markets in a way. You see a little bit of bridging, of course, between UAE, Saudi, and I think Saudi's doing fairly well with their strategy and have re-upped their funds and are continuing to deploy. A lot of the rounds may be counted in one country or another, but there's some movement that happens underneath that isn't always seen. So there's a labeling issue as well. You face this, I face this. It's like, is this a fintech or is it a health tech? Is it a Saudi company or is it an Egyptian company? Like the labels change quarterly, so it might affect the numbers, but it's probably a rounding error. I aside from Saudi and UAE today, I think Egypt is still a contender in the market, strong contender in the MENA market. I'd still give it a number 3 position. It's had its challenges at the economic level and the currency levels and things like that. But the activity on the ground seems to continue to be strong. We've seen companies doubled and tripled their revenue year on year, only to split it by a third the 4th year just because of the currency thing in dollar terms. So those companies, maybe their valuation actually doesn't change even with that 1/3 or 70% drop in terms of dollar revenues, but their valuation doesn't change; it stays flat, which is actually a really positive sign because their growth in Egypt is doubling and tripling still. So I think they're going through some of the toughest times for a founder in a particular market, but Egypt, I think, will come out of it eventually once the markets recover. We're this whole cross-border startups, banking, and things like that is an increased topic we're hearing everywhere. And how to move money around is something that we also have to fix because it's one of the problems that startups are facing across these markets. Aside from that, there isn't an insignificant contribution of activity coming from some of the smaller companies as well, from Algeria, from Tunisia, Kuwait, and others. We don't talk about them all the time because time is short sometimes in these conversations, and it's just there are deals happening like there were deals happening before, and I think there's very strong talent in those markets as well, building locally. So sometime they'll come onto the regional scene once they start expansion. I think we all, as an ecosystem, need to build better tools for expansion across markets because cross-border is more challenging than in most other multi-country regions. And similar challenges that Southeast Asia has faced in the past.
And of course, you're an LP that makes investments in funds, and I believe that you made an investment in Partech. That's an African-based investment funds. No doubt, you've been approached by many international VCs, and there was a talk that there was a lot of tourist VCs that were coming to the region, and the rhetoric has changed from the LPs as to having to deploy in the region. Are you seeing more international entities actually looking and wanting to set up in the region and invest in the region over the last couple of quarters? Or given that the global landscape is a little bit more challenging, everyone's in a bit of a hold and wait situation?
Absolutely. I mean, in the last 24 months, I think we've seen almost every, seems like almost every fund, top tier, second tier, and everyone else coming out to the region. Primarily, it's because of the VC winter in those markets and the fundraising from the region, quickly realizing the second point that you made, that, look, the rhetoric and the position in the region has changed. There are entities here at the top level, sovereign funds, let's say, who their tickets are much, much larger, and they've always been investing outside for diversification reasons. But this subset of funds and LPs like me and like many of our peers here, their job was developmental. That's why they were formed. They were formed as sub entities under the large funds in order to do local and regional. And so it's not surprising that the rhetoric would change with them, especially. I'm pretty pleased with that. We're all singing the same song here, which is, all right, if you come out, it's not just one shot, take a flight, and you're going to fundraise and carry the suitcase back home. for many reasons, that wasn't a great strategy to begin with, but it had its time. And I think it's a dual strategy now that we need to be thinking about, which is there should be certain institutions that are focused on buying or investing in assets abroad in different markets for different reasons in different sectors. However, now there's a pretty complete subset within each country for developmental regions locally and regionally. And we're a part of that camp. And in that camp, certainly, if you're going to come out here to fundraise, which everybody seems to be doing, we want to see skin in the game, and we want to know what you're going to do here. And there needs to be substance and authenticity to your interest in the region. And so that usually comes with investments and presence, something we require, and I think a lot of my peers require as well. And honestly, it is working. We've done Partech, as you mentioned. We've also done Arbor Ventures, a global firm that's vertically specialized in financial services. They have presence on the ground. They've had investments here before. So we'd like to see that kind of cross-pollination. The reason why a lot of them are coming here with the suitcases is obviously the VC winter, and there's a dry up, and they've heard that we have capital here. But it's serving multiple other significant benefits for us, is that the familiarity with the region is increasing significantly among these people who are traveling here. And there is a genuine affinity, I think, to the markets. I think initially maybe it was in lip service, but it seems to be changing to genuine interest. And we're seeing more of it. And honestly, if you see some of the announcements that are out there, hedge funds, private equity firms, investment bankers, and others are coming here, and you're not coming here to fundraise and take it somewhere else. They're coming to establish market presence, to take advantage of all these transactions that are growing in the region. Maybe not in the venture space that we're looking at, but the asset classes higher up. So I do think that this is great on the whole. The visitation and the interest and the familiarity with the region is something we always want, the outside to see. And all of our sister organizations here within the Dubai government, UAE government, Saudi, and others have done amazing jobs across the pillars of tourism and safety and infrastructure and access and network. And I think people are starting to see that more clearly even than before. So that's going to somehow have a positive effect on us. It's just not an immediate effect.
So one type of entity that doesn't necessarily need to fundraise is corporates. They either have balance sheets or they end up creating funds for corporate venture capital. Yesterday, PwC did announce a report on GCC corporate venture capital. They used a lot of data from MAGNiTT. They were showing that there was almost a threefold increase in capital deployment from corporates. Mm-hmm. What role do you see them playing? I mean, having had the experience in Silicon Valley, knowing the venture space globally, one of the predictions I had made at the beginning of the year that corporates will play up to about 20% of all investors of the investments that are being made in the region, because they can. They've got balance sheet, they've got cash, they've got an ability to play that. But there's still somewhat of a hesitancy here in the region of how to play that role. What do you think that corporates can play in especially this kind of downturn to really support or invest or opportunistically acquire in this type of environment?
Yeah, I was going to mention that. So my hope and desire, and it's always been the case, whether it's the US or here, is corporates play a vital role in the uprising of a startup ecosystem and the completion of the investment cycles. So, and those three steps would be play with startups, first of all. This is something we're lacking in the region. Private sector does not play with startups as much as they should. And then if they like that, start investing. And we have a number of friends of ours, yours and mine, that are running some of the newer CVCs that are out there, and they're doing a great job. And I think CVC investment can be great. It just depends how it's done and executed. Like, it can also be poisonous for very young startups, and it just depends how it's done and what their intention is. But we've seen some great ones actively investing. They're probably helping prop up those numbers that you mentioned. And I think that that's increasing in Saudi and UAE especially the most, which I'm really, really happy to see. But there's a third step, as you mentioned, for corporates, which is to eventually acquire, to help us complete the liquidity cycles of these companies and honestly prevent obsolescence for them. So I think corporates will play a vital role. It's always been private sector, government, academia are the peripheral factors, and we have our core cycle, which is talent, investors, market, customers, and exits. So I think it's very good news that they're coming in. 20% seems appropriate to me. If that is the case and they fill that in a best practice kind of way, that could be enormously positive, because I think it will lead to the other two things, which is they'll start to be customers and they'll start to acquire, hopefully, eventually. It just depends how they're structured. If they're proper CVC off balance sheet versus spin out funds that are sponsored by that corporate, gives them more autonomy to invest in companies that are less synergistic to the company. But if they're off balance sheet, it's typically investments that are synergistic, which both are fine if they're done right.
You're a man who has a very good pulse of the street. And when you realize that venture funding is down, it means startups aren't raising, which means that their cash flow is reliant on being unit economic and positive or profitable. Carter's numbers, at least based on the set that they showed and the slide that I showed earlier, show a record number of shutdowns. It's something that we don't speak about too much here in the region, and it's very hard to track because we're not a regulator. It's very difficult to know when a company is actually shut down or not. Do you see that happening here in the region? And is this something that we aren't necessarily aware of in terms of the metrics and the wider market, or are people actually managing to weather the storm better than we had imagined?
So from the position of a fund of funds, we will see shutdowns in the portfolios of the funds that we've invested in. Of course, we're new on the scene, so those vintages would be, maximum go back to 2020, 2021, were the funds that we maybe have open. Were open when we started to invest in. So we see some of it, but there's a trend that had happened since the beginning when you and I were first involved in the ecosystem here. It's that MENA companies tend to gestate longer between rounds and don't matriculate as fast. They also seem to be very survivable type of entities or founders, where they could go 2-3 years at pre-seed and another 2-3 years at seed, and a couple saves here and there just to hold them over. But it's not the kind of momentum you expect from a venture investment. And so I think our companies in the region, especially at the seed stage, didn't die fast enough. So if they had died at the rates that we're seeing in the US, that would have been normal. 460, I think you showed, and then it jumped to the 770. But that was normal. I mean, there's a certain percentage of startups every year should be dying, and funds portfolios every year should die. In the way when we do the modeling, we're accounting for 60 to 70% to go to zero. And when do they go to zero? It should be within years 2 or 3 to years 6, maybe 5, 6. Why are they lasting longer than that if they're just not going to make it? But that wasn't the mentality here, whether it's the first black swan we felt, or the second one, or COVID, or whatever. These companies seem to be able to go into hibernation mode and survive. We wrote off companies, let's say right before COVID, only for me to see on LinkedIn or somewhere else that the company's still there talking, what are you still doing around? You haven't been funded in years. Your business isn't really going anywhere. So I think there's some blurring effect when you look at an emerging market like here. We have founders who really never had lots of means anyway. So funding or no funding, they're there just like they were there yesterday. So I don't think that's necessarily good. I think our evolution, what it would look like, is that companies grow faster or die faster. The whole zombie middle ground is not a desired state for anybody in venture. And so those founders should probably just see the signs on the wall and close the door, pack up, and go do something else if it's not working, or really consider what space and what industry they're in, and that they've taken venture capital, which means there's an expected growth rate for those companies. This is not the same thing as saying grow at all cost, but if you do take venture capital, there is an expectation of the scalability and the growth of that company. And there's a sort of maximum timeline of 10-ish, 12 years where those funds need to return capital to their LPs and recycle that money. So I don't think it's a bad thing for companies to die and die faster. I wish they kind of would die faster. Or we've had great, very commendable founders who said, what, I couldn't find product market fit. I'm giving the money back to my investors and shutting down. That's the mature thing to do. Why keep dragging it out until every penny in the bank is just gone, and then you face problems with the closing costs of closing down all your entities and everything, and you might not have saved enough money to pay your severance to your employees or pay final salaries and things like that, and that's happened as well, and that's not good. So I think in the just the recent period, these last few quarters, we're certainly hearing of companies deciding to shut down or dying. We're seeing it in the portfolios, some of the portfolios we follow, and third is, you know, this week, well, over the period, there's been a number of AGMs where we're looking at not only the funds that we've invested in, but some of their prior funds. And they do talk about those things for every fund, right? So they say in this fund, it was during this period, and you know, 20-30% has been written off of the fund. So companies are dying. You're absolutely right. We're not in a culture here that openly speaks about these things enough.
But then, I mean, just looping that back, just to double click on that, if we assume that the Fed is now saying that interest rates aren't going to be coming down, in fact, they might be going up, what's your view, one, on funding for the next 9 months, and two, survivability of companies? I guess that will really prove those that are able to survive this environment. And then you say that there's a lot of dry powder, so actually maybe it's a matter of deal flow and whether they're good companies. And I mean, what you're going to see in terms of venture investment over the next 9 months, assuming for the sake of argument, the Fed rate stays the same for the next 9 months, and there's actually no change up or down. And two, what do you think that startups going to end up having to do?
Well, we had a lot of regional discount in the first couple waves of the startup movement in the region. You know, I came from California, as you know, and the bar in my mind of mentality was a certain level. I come to the region, it's like becomes more impact oriented, development, or you know, poor founder, it's a pretty dumb idea, but you know, I'll try to support them, this and that. Okay, those discounts are fading now. We're maturing as a market. We're coming out of, everybody's coming out of COVID and the downturn and all that. To be honest, the bar is going up. There's no more of that discount. You've got to be a great global company. And if you're not going to be able to compete on a global scale, I'm not going to pull global money into you. And I'm probably not going to be able to, you're not going to be able to garner interest from global capital. So that is a huge consideration, back to the points we're talking about global effects and interest. So I would consider that making an investment is like, okay, this is a great company starting from here, but it probably needs to expand to Europe or US or Asia or somewhere. Well, who's going to do their growth rounds when everything is dry right now? And if their numbers are not up to par with global standards, I mean, in some of these AGMs we're meeting founders from all over the world and talking about their businesses. Like, wow, like this is some serious business. It's not just, you know, this dinky app or, you know, some, you know, kind of yesterday idea. And I can tell you, I can speak for ourselves, but I think this is a common refrain across the funds that we talk to a lot, is the bar is higher in a number of ways, not just unit economics, cost savings, and governance. Those are table stakes all of a sudden. But again, it's like we're all traveling to other markets and seeing what startups look like in other markets. And besides the advantage we had, which was resilience, right? We had founders more resilient than anywhere else. We had founders generating revenue earlier than their peers that are at 100 million valuation at the start, you know, like crazy stuff like that. Okay, those are things we were better than others at. But in general, we're not a global standard in our startups. And so you take a very few that have had these mega deals lately, and you look at the insides of those companies and the founders who started them, they're world-class. And I think we're all kind of tired of the impact investing side of things, or mentality we had, and I had, right? Just because we wanted to help our region. But the bar is higher now. And now we're integrating with international investors. We're integrating with international networks and markets, and they're cross-pollinating back and forth. Well, we need to be on the same standard as they are. So it is slowing us down significantly in deployment. I agree. We have the powder, but our bar is higher. I certainly know that's the case for me and my team here. Is we're looking for certain technologies that are disrupted for the next era. 9 out of 10 startups that pitch us are not, just from the pitch, right?
I want to double down on these 2 points, but I'm just going to make an open call for questions. So we still have about 15 minutes afterwards. If there's questions, please put them in so that we can get to them. But 2 questions before that. So you're the first time, actually in a long time, I've heard somebody be saying highlighting the point, and please correct me if I'm wrong, there's a pipeline issue of actual startups that are fundable here in the region? And two, does that finally mean that attracting startups from abroad and setting up is a strategy that becomes a lot more appealing? So for all of these potential tourist VCs who are looking to raise funds, say, sure, maybe, but bring your companies here, not just your money here to invest in the region, but bring the companies, let them expand here
Absolutely.
and build out the infrastructure.
Yes, absolutely, both. I mean, to the first point, let me just speak about us. So we've always set out to try to push the envelope on technologies in the sectors that we invest in, and leave the lower hanging fruit to the private VCs that we fund, because that's what they're good at. They do it. We play a role as a government fund when we're doing direct investments, try not to cannibalize the private sector, but to complement in the areas they may not have been investing in, or to co-invest to double down on what we think is strategic of what they are investing in. And that's still the same case today. So when we're thinking about a direct investment on our own, before a VC comes in or alongside a VC, we put a higher bar of technology on that startup. So if it's just another yesterday kind of idea, it's not my job to do that. And it's not going to help us move forward in terms of tech sophistication. On the second point, absolutely, every fund that we talk to that's coming from the outside, we ask them about their portfolio. Our interest in that fund is also an interest in their portfolio. We have a lot of startups coming out here to fundraise because somebody told them, you should go try the Middle East since you have no other, hope. Look, if they're the duds of their own market, it's unlikely they're going to get funding from us, especially, again, same as investors. If they're coming with a suitcase and expect to go back home with it, that's not what we're here for. So, but there's a really, really tempting and interesting opportunity I think we need to capture more of, is there are some really sophisticated, interesting technologies and companies where regulation here is better than their home country. And that goes across healthcare, Web3, fintech, a number of other areas where they feel like their market penetration is going to be smoother here, and people understand what they're trying to build. And it's a great data set for them that they may not get in other markets. So there's a lot of legitimate reasons why the strong portfolio companies from around the world very much should talk to us and others and consider market expansion to the region. And many sister organizations in Dubai, Abu Dhabi, and Riyadh are helping with that kind of inbound landing. And I'm really excited about that, because to another point, that we have an intention to invest deeper, and we have D33 and we have the R&D strategy coming out of the foundation. Those kinds of things are going to set up a foundation for us to do deep tech, because of R&D and grant culture being introduced here in Dubai. Okay, amazing. But that's a 10 to 15 year timeline to really mature and ripen. But the great thing is that because of geopolitics happening around the world, we see an influx of talent coming with their IP and setting up shop here, maybe even closing it down where they came from. Super, right? That's a shortcut to this R&D strategy for us. And this cross-pollination coming from some of our portfolio funds, we mentioned some of the internationals, they're seeing the entire global market. They're investing across the global market, A-plus, portfolio companies that you wouldn't get naturally here. But there's a lot of interest these days, and they're bringing them around. We're all meeting together. We're helping introduce them and help them land here. And I can't wait, really, for more of that to happen, because you're talking about verticalized funds like Arbor, for example. They bring a set of knowledge and cross-pollination, and then their portfolio companies bring things from the problems in the markets that they came from, and we translate those problems to what we have here. And it's sort of a different level game. So going back to deal flow in MENA and the younger, less forward-thinking startups, or weaker ones, let's say, in terms of their value propositions, like, why are you starting this startup? Oh, I think it's cool. I'm going to deliver food again, or something like that. But, I think a lot of the VCs here are not so excited about those deals. It's not that phase anymore. We're moving on to another phase where we want to see globally relevant companies with local context. And the bar has gone up.
Last question from my side, although I could ask many more if we don't have any other questions in the chat. Exits. I mean, we always have to end on exits. Everything comes down to exits. It's the liquidity event for the VCs. You mentioned the need to actually pay back to investors if they're LPs. Startup founders, their goal is to ultimately exit and then potentially start up a new venture. Started the year last year, record year. It wasn't. It was half, or at least a third less than the year before, which was the liquidity boom of 2022. we're starting off very sluggishly in the exits. So I guess 2 points. One, is this going to be a year of record exits? Is this something that you are likely to see, or given venture and interest rates, it's going to be another sluggish year? And two, this unicorn IPOing concept that the region has been obsessed with for at least 5 years, forget unicorns, just IPOs. Is that something that in a challenging venture environment and high interest rate environment like this year is likely to catalyze, or is that again something that we need to push into 2025 and beyond?
I mean, if I'm honest, look, we are making great progress on those trajectories: M&A, secondaries, IPOs, liquidity. It's not going to happen overnight, and I don't think it's extremely correlated to the markets that are the market effects. We're going to see a few more IPOs coming out, I think, this year. Those are really strong companies they've been building for a long time. It's not like it's just popped up out of nowhere and there's an IPO trend. I've been wrong more times than you, I think, in my predictions or expectations, especially around secondaries and M&A. In my fourth downturn, fifth downturn that this was, I certainly predicted that the year coming out of the downturn, we're going to see a rise of M&A and secondaries because that's what's supposed to happen. But it didn't. And so what's going on and why aren't these things happening? We've tried to facilitate, and I know a lot of our fund managers also have tried to facilitate M&A conversations. They're tough. I mean, they're tough, especially if people are not used to having those kinds of conversations or understanding the value on the other side of the deal. So it's still a learning curve. I don't think we should expect these things to happen overnight, but they are progressing in the right direction. They just might not come down like a waterfall all of a sudden. The IPO markets, and there are many people better suited to speak about this than myself, but I can see some gaps still in the younger startups and the readiness for those startups to reach EBITDA and be able to go on a roadshow and get their IPOs in a healthy place. Like, I think in some cases we're trying to rush that prematurely, and we should let the right ones do it when they're ready, and they would know when they're ready. And the others, let's just let it take its natural course. M&A is something we. Yeah, go ahead.
No,
that's for IPOs. I think M&As is something we may and should crack the whip on. There is no reason why we shouldn't have more M&A. There are companies struggling, larger companies, let's say, smaller companies with solutions, but just haven't really figured it out or don't have the funding, dying and washing away. That's a waste of resources on both sides. And the larger companies need to get their head around what M&A is for and how to do it properly and do more of it.
Great, cool. Look, we're getting some questions, so please do share them. It's always a great way to engage. Asif asked questions. What trends does MAGNiTT and the FDF see with regards to ecosystem of angels and their investment patterns? What can the ecosystem do to develop a more mature angel funding ecosystem? I think it's a great question. Just on my side, it's very difficult for us to track angel investments. It's something that, because it's very hard to verify and it's not necessarily easy to capture, we are unable to. We capture early stage. But naturally, VCs have moved towards earlier stage because they're, one, less risky compared to late stage investments. And if you're going to invest, then they're likely to exit in 7 to 8 years. So your payoff is a lot longer. And there's been a general shift, which I alluded to in the investor ticket size pattern. But Sharif, your point on developing an angel ecosystem here in the region, especially to capitalize early stage investment.
I agree with your points, and the question is Christian, because we, those of us, I think, have noticed that pre-COVID, we had a lot more angel groups and it looked like a lot more visible angel activity. I can tell you from just being privy to cap tables that come across our desks all the time, there is still angel activity, but it is harder to track and it's less visible outwardly. There are less angel events. There are less angel groups visible in the market. I think Saudi is doing a pretty phenomenal job bringing in angels, family offices, and private investors in general, just non-VC investment. They're doing a phenomenal job creating communities around that, and I think that's what's needed. The Web3 community here in Dubai, which is extremely strong, also has that today. It's just the regular startup community around here and some of the other countries. What we used to be a very strong angel market seems to be waning visibly. And I'll tell you that the non-visible angel investments that we see on the cap tables, those names are not something we've never seen before. It's a lot of names you've seen before on other cap tables. And the way those deals tend to happen is Philip sees a deal, he calls me, he says, I know you write checks, you want to put a check in here, done. So it never went into the market, right? Like, and it didn't get circulated. The founder didn't talk about it. It's not reported. There is no angel demo day, angel group demo day for people to know who those people are. So it's a lot of quiet deals happening. You talked about the buffering of early pre-seed and seed stage in the region and how it really hasn't been hit as hard. Believe it or not, that some of that support is from the angels. Continuing to support those deals, and there's no noise about the who they are and where they are, and some of them are not very public. It's I only do it if Philip calls me. Philip calls me, I'll do a check here once a year, twice a year, and a lot of the same names seem to be circulating in the market.
I have strong views on this, and that there's a lack of incentives for this, which is something that definitely from a government perspective could be created. But that's a complicated process, which, for instance, the UK is a leader in being able to create capital guarantees and tax incentives so that people actually put money in.
You're right.
I think at a very simple level, people aren't comfortable investing in companies locally and therefore wait for the holding company. And that's a cost. And that's a process, and that needs institutional money to be able to actually do. Just conscious of time. So David, the question about the largest corporate VCs, that's on MAGNiTT off the top of my head: Aramco, STC, Eand, Shalhoub, Majd Al Futtaim. Those are some of those type of players, but we can get you a list of those. Sharif, and if we kind of just try to get to a few of them, so to try and be brief, expanding from the UAE to Saudi and vice versa remains a complex process today. Are you expecting more regional integration between the GCC countries, especially in terms of regulation?
Yeah, so I was just going to commend Saudi for their angel matching program, because that was a really smart incentive program similar to the incentives in the UK. And it adds more capital to the startups, so the startups are incentivized to bring that to the table. But in terms of the cooperation, you know me well enough that I that's all I dream of. I mean, I hope we can all work together, because that's when we become the strongest. We went through an ebb and flow of cooperation, or sort of one MENA to siloed MENA. I think we're going to start coming out back to a little bit more integrated MENA. I won't say a one MENA, but GCC certainly has attributes to it that make it similar to each other versus the rest of the MENA. Qatar back on the scene, which is $1 billion fund of funds program. There's a very cooperative attitude on all sides from what I've seen. And I think the same is going to go for the other markets, especially let's focus on the most active UAE and Saudi. We're seeing a lot of back and forth between Saudi to here to Saudi, I guess was already happening, but we're seeing a resurgence of the pre-COVID Saudi to UAE movement. And it's not just the startups, which I was initially pretty shocked about, but it makes a lot of sense. Like if you just take away any other sort of developmental angle of it, startups cannot grow in one country alone. They need to expand. They need to diversify. They need talent and strategic sets that are outside of their potential home court. So it does make logical sense. And I'm glad people are thinking very openly and logical. It's like, what does my business roadmap need? I need to move to this market or that market, and I'm going to go there tomorrow. So I'm really happy to see that. We're seeing a lot more Saudi startups with presence here. Saudi funds already, a lot of them have presence here. They always have, sort of thing. So it would be really easy and natural for us to sort of ebb back or flow back to an integrated, at least GCC.
Out of interest, are there associations for fund of funds cross geography that actually collaborate? Is there a way of communicating, or are they also in silos?
Across regions or here in the region?
Regions. In fact, do you speak to your peer in Singapore and Indonesia and in the UK, in other kind of geographies, even within the region?
We do, and I know my peers here in the region do speak to the outer regions and the LPs and fund of funds, endowments, pensions. But this is small talk, conversations at conferences. How do you guys do this? Oh, we do it this way. It's that kind of relationship. more so than what it is in the region. So in the region, at least when we started, we called everybody up, all our peers across the markets, and started to align better, almost as an LP association, if you would, saying, look, like, how can we reduce burden on the GPs that we invest in, and subsequently the founders and portfolios that they invest in terms of reporting, and let's all sort of align on a reporting sheet. And we've done that with some of the largest LPs and ourselves together. So we've collaborated on a number of things at sort of macro level ecosystem of the region, and then learning and sharing with outer region. So, but that's a bit lighter. I just came from a conference yesterday and today where it was all basically international LPs, and so we learn from each other. I think we're at a point now where we start to say, let's stay in touch, because it might be interesting for you guys in the future to come here. Or now you see what your VC is doing that you invested in Dubai and Saudi. Come back next quarter and let's do more here. It's increasing in the participatory way. Before it was more water cooler conversation. That's really cool. I like how you guys do that in Singapore. I like how you do that in the US. Oh, I didn't know that was happening in the UAE. But I think now it's hey, we should work together. So this is early days. You're getting a sneak peek. The regional ones, it's been about 2 years where we call each other all the time, and actually we do due diligence together. Sometimes we share due diligence. I know a lot of the VCs will do that too on a non-reliance basis. We also do check-ins with our peer fund of funds and say, are you seeing these trends or those trends? Is reporting what I see in reporting matching what you see in reporting? Are there tools that we can be using together to make the ecosystem stronger? Or the one you mentioned is a big one. I think we're going to try to work on this quarter a little bit more, but how do we make these bridges a little easier? Because like they're painful, right? Market expansion has always been painful no matter what, but here in the region, it has its own idiosyncrasies that we need to and can solve. I don't think they're impossible to solve. I remember when Sagia and our friends at Sagia back in the day, pre-COVID, which now Misa, when they started running in this direction, right? And the website, wasn't fast enough or working, wasn't the right questions, let's say, for an application. They would say, here, just send it to us over WhatsApp. I'll fill it in on the back and I'll give it to you by tomorrow. Done. And I think that mentality is what's going to move through bureaucracy, move through friction. And who really suffers the most? Maybe you're facing pain, I'm facing pain. Well, you are a founder, so maybe we're facing pain when we see it or do it. But really, at the end of the day, it's the startup and the founders who are really, like, the pressure on their shoulders is a lot, and it's sometimes enigmatic. I don't know what's holding up the process. I did what I was told to do. I'm still waiting for an answer. That's easy to fix, and so I think there's an obligation on folks like me and my team to talk to our peers in those markets and start to make it grease the wheels a little, if you will, on these kinds of processes. So maybe joint SOPs, right, where we can work with other countries and say, okay, there's corridors. We are doing this, by the way, with, for example, we started with Egypt last year, seeing what was happening in Egypt, but knowing a lot of those companies are great companies. Why don't we help them with bank accounts outside of Egypt, or setting up entities here, just to kind of hedge their situation? It's a great strategy. So this corridor strategy, I think you were talking about the corridors with Southeast Asia before. Certainly, I wouldn't even call it a corridor, maybe a causeway. We need a causeway between Saudi and UAE. It should be a 10-lane highway on each side, right? And fast lanes. So I'm hoping we all work on that stuff together and get some progress done this year, because I don't see a future of single country markets in the region anytime soon.
Sharif, thank you very much. I really appreciate it. I feel like we've hit the time. So really thank you for your time. As ever, always enjoy it. It's always good to have it on the record as opposed to off the record. Hope to catch up soon, and I hope everyone found that interesting. Please do share your feedback and any comments, but we aim to have a couple more of these protagonists share the insights from the ground, and hope you find it useful. Sharif, hope to see you soon.
Thank you so much. Thanks, Phil.
Thank you, sir. Take care. Bye-bye.